Hey guys, Mal here again. Many investors believe that simply owning an S&P 500 index fund means that they are properly diversified or in a diversified portfolio. But diversification is more nuanced than owning 500 companies. The S&P 500 is a market capitalization weighted index. That means the largest companies receive the largest allocations. Today, a small group of mega cap technology companies account for a substantial portion of that index. Companies like Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta collectively represent well over 30% of the S&P 500. In other words, a significant percentage of your portfolio's performance may depend on just a handful of stocks. This concentration creates risk. When those companies perform well, investors feel great. But if those companies face valuation compression, regulatory challenges, slow earnings growth, or changing market sentiment, portfolios heavily tied to the index can experience a meaningful downside return. This doesn't mean that the S&P 500 is a bad investment. It simply means investors should understand exactly what they own. A properly allocated portfolio considers more than just the number of holdings. It evaluates sector exposure, factor exposure, economic sensitivity, valuation considerations, risk tolerance, time horizon, and diversification across different asset classes when it's appropriate. Another critical component is backtesting. Before implementing an investment strategy, it's important to evaluate how that strategy would have performed across different market environments. How did it behave during periods of high inflation? How did it perform during recessions? What happened during rising interest rate environments? What were the maximum drawdowns investors would have experienced? Backtesting doesn't predict the future. However, it provides valuable insight into how a strategy has historically responded to various economic conditions. Investing shouldn't be about blindly owning whatever is largest at the moment. It should be about intentionally constructing a portfolio aligned with your goals, risk tolerance, and long-term objectives. At Portfolio Capital, we believe portfolio construction matters just as much as security selection. Because successful investing isn't just about pursuing returns. It's about understanding the risks you're taking to achieve them.